Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our November monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. It was great to see many of you. We had approximately 100 in attendance at our recent quarterly investment forum. Let's get started with the most recent data. A really bad jobs number in October, only 12,000 jobs added. Some context is that it was likely affected by hurricanes and the Boeing strike, but nonetheless, a really bad October jobs number. And a little bit more context, 12,000 was the net jobs added, but that was only because 40,000 government jobs were added. Private payrolls dropped by 28,000. So again, October jobs number was not good. The question is whether that's a trend. We also had some downward revisions in August and September. September was adjusted down to 223 versus 254, and August was reduced down from 159 to 78, which would have been the worst in 4 years, if not for the October number. And this follows downward revisions in a 12-month ending March of 2024, where almost 800,000 jobs were revised down. So again, whether October is a one-off or not is something that we're paying very close attention to. But again, a very weak October jobs number. Real GDP in the U.S. economy came in at 2.8. Expected was 3.1. So again, overall an economy that's slowing somewhat, but again, still expanding. As it relates to markets are still trading at or near all-time highs, but much of that, especially on the S&P 500, is driven by these 7 stocks. So the Mag 7, as it's called, and it includes the names here, drove 44% of the return year to date. So again, that's still a very dominant kind of contribution to the S&P 500 on just 7 stocks within the S&P 500. So the question is that widening at all? It is a little bit. In the third quarter, more than 60% of S&P components beat the index. That's compared to only 25% in the first half of 2024. So that's some indication of some widening and broadening out of return attribution. As it relates to the Fed, this is kind of most people are following this, the fact that the Fed cut rates for the first time in 4 years in September by 50 basis points. What's interesting about what's happened to interest rates that are traded since then is they've moved in opposite direction. So in this current cycle, which is very short, only a few weeks, the 2 years gone up by 54 basis points and the 10 years gone up by 59. This is prior cycles and what interest rates have done 3, 6, and 9 and 12 months. So it's a bit of a paradox where the Fed is cutting rates September at 50 basis points, likely another rate cut on November the 7th. And yet the public markets that are trading the 2 and the 10 have gone in the opposite direction. So what's next for the Fed? The Fed's in a quiet period now, but is meeting again on November 7th, and markets are predicting a 25 basis cut as an almost certainty then. So how does the Fed rate cut affect stocks and bonds broadly? A lot of that depends on whether we go into a recession or not. So on this side, if we do not go into a recession over a 12-month period, it tends to be very supportive of both stocks and bonds. If we do go into a recession, stocks tend to be down and bonds tend to be up. So a lot of how assets perform post Fed rate cut is dependent on whether we get or not a recession. U.S. debt level remains a concern, spending 120% of GDP, and that's projected to just get worse, with over $1 trillion now being spent on just debt service. So again, we talked about this in the forum, when this is going to trigger a more negative consequence and what will trigger it kind of remains to be seen, because while debts are near all-time highs, so are stock prices. So again, it's something we're following carefully, but it's definitely something that's a concern. Again, over $1 trillion just to service the debt as of August. So I know we all know what happens on November 5th. You may feel like this guy who asked the pharmacist if there's anything stronger for anti-anxiety going into November 5th. But a quick mention about that as it relates to possible outcomes. This top graph looks at the GDP under where Republicans or Democrats are in charge of all three, President, House, and Senate. And the bottom looks at the stock market measured by the S&P over that period of time. What you'll see is that Republicans have only been in control 10% of the time, and this is the average output of the economy. Democrats have been in control more at 30%, and this is the average output of the economy. And 61% of the time, there's been divided government, and this is the output of the economy annualized. As it relates to the market, again, measured by the S&P 500, same 10% of the time, Democrats 29, divided 61, and this is the respective performance of the S&P over that period of time, going back almost 80 years. So you'll see that whether it's Republicans in charge, Democrats in charge, or divided government, which is much more probable historically, both markets and the economy have tended to perform well. That doesn't mean that there won't be added volatility surrounding and around an election, but that over time, again, from an economic measure and from a market measure standpoint, tends to do well in both scenarios. So this is a look at what happens in different election cycle years. This one measures the off years where there's no midterm or presidential election. And you'll see on average that's 15% or just under. And the most recent example of that was 23 when the markets were up significantly. So kind of in summary, some kind of pessimistic and optimistic thoughts. On the pessimistic side, again, we got a bad reading for jobs in October. That indicates a softening economy, a softening consumer. That's something to be pessimistic and that we're watching carefully. That the Fed cuts rates, but less than expected. Again, we've already had one rate cut and we're likely to get at least one more this year. Geopolitical remains an elevated level of risk. Debt levels we just spoke about is a cause for concern. Earnings disappoint at some point. And then we have an election that, again, short-term volatility, especially if a contested election, could very well be the case. On the optimistic side, again, the most recent quarterly reading on GDP was 2.8. So a soft landing continues to be possible. Inflation is lower, closer to Fed target. That the Fed does continue to cut rates, in not just in 2024, but into 2025. The market performance continues to widen beyond the Mag 7. Earnings is supportive of stock prices. An election, regardless of the outcome, is something that is behind us, and the market can focus on kind of fundamentals for the end of 24 and into 25. So none of this replaces contacting us directly about how all these things impact you. Please feel free to contact us if you have any questions. We're here to serve you. We also hope to see many of you. We'll be sending an invitation out to this soon at our Curbside Event, Tamales and Treats, Saturday, December 7th. And we'll be partnering with Finishing Touch Ministry. We'll share more information about all of that in the very near future, but we hope to see many of you there. Until we see you again, be well and take care, and please contact us if we can help in any way.